What if you could see a stock market crash coming? I mean, that's the billion-dollar question for any investor, right? Is it actually possible to find the warning signs? The signals that might be hidden in plain sight before a major downturn really hits?
Okay, let's just dive right in. Take a look at this chart. Each one of those red zones is a market correction, a time when, let's be honest, portfolios took a serious beating. But what if there were clues, signals flashing red, before the drop? Well, a recent study tried to build a machine that could spot exactly that.
So this whole thing really boils down to one central question. Can we predict a market downturn using data that's out there for literally everyone to see?
Now, this isn't just some random thought experiment. We're actually digging into a master's thesis from the University of Vaasa in Finland that took this challenge head-on. They really set out to try and crack the market's predictive code. Their researcher, Elias Kuskinen, looked at daily market data over a nearly 4-year period. And that period, as you just saw, had plenty of turbulence, including that massive COVID-19 crash. So plenty of data to work with. The goal here was basically to build a really smart sorting machine. The idea was to feed it a ton of public data and see if it could learn to tell the difference between the calm business-as-usual days and the something's about to happen days that tend to pop up right before a correction. So what kind of clues did this machine actually look at? All right, let's meet the suspects. They basically fall into 3 main categories. First up, you've got option market data, which you can think of as the fear gauge. Then there are financial indicators. We'll call that the value check. And finally, macroeconomic indicators, which give us the big picture. All right, let's start with that fear gauge. One of the key clues is something with a fantastic name, the Volatility Smirk. Now, this sounds complicated, but it's basically just the price of fear. When big-time investors get worried, they buy put options to protect themselves. You can think of it as disaster insurance. The more they're willing to pay for that insurance, the steeper the smirk gets and the more fear there is in the market. And this chart just illustrates the point perfectly. Look at that red dashed line. That's the volatility smirk. See that huge spike in early 2020 right as the COVID crash was happening? That is fear made visible in the data. Okay, another clue from the options market is the open interest difference. This one's a little more straightforward. It's just the number of optimistic bets, the call options, minus the number of pessimistic bets, the put options. It gives us this raw, unfiltered look at the overall mood of the market. Next up, from our value check category, we've got another crucial clue, the bond stock earnings yield differential. It's a mouthful, I know, but the idea is actually pretty simple. It just asks a basic question. Are you getting paid more to take the risk of owning stocks? Or is it safer and maybe even more attractive to just own a government bond right now? Okay, so the model looked at all these clues, the fear gauges, the value checks, all the big picture stuff. So which ones actually mattered? Which ones were the real predictors? Well, the verdict is in. So the billion-dollar question. Out of all these different indicators, which ones were the real telltale signs that a drop was on the horizon? It all came down to just 3. Number 1, the volatility smirk, our measure of market fear. Number 2, the open interest difference, that raw market sentiment. And number 3, that bond stock earnings yield differential, the classic stocks versus bonds value check. Now, here's what's so cool about this. It's how intuitive these results are. When the volatility smirk goes up, meaning fear is rising, crash risk gets higher. Makes sense. When the open interest difference is high, meaning there's more optimism out there, the crash risk is lower. And when stocks look more attractive than bonds, the risk is also lower. It all just kind of clicks, right? But, just as important as what worked is what didn't work. Some of these widely watched indicators ended up being total false alarms in this study. And this is where it gets really surprising. A bunch of indicators that you hear analysts talking about constantly, things like the yield curve, key commodity prices, even measures of stress in the banking system, they turned out to be duds here. In this test, for this time frame, they just weren't reliable predictors of a short-term drop. Okay, so we have our winning predictors. But how good is this model, really? I mean, are we talking about a crystal ball here? The final score came down to this one number, 59%. So what does that even mean? It means the best version of this model could correctly flag a crash day with 59% precision when it was tested on data it had never seen before. Now, look,
That's obviously not perfect, but it's a real notable edge over a random 50-50 coin flip. As the author Elias Keskinen puts it, the findings provide, quote, evidence of existing market inefficiencies and the lead-lag relationship between option and equity markets. Let's break that down, because it's really the whole point. The crucial takeaway is this. Information, or maybe sentiment, seems to show up in the options market first. The big money, the informed investors, they seem to be placing their bets there before the actual stock market starts to fall. And that brings us to the really big final thought. For decades, we've all heard about the efficient market hypothesis, this idea that all public information is already perfectly priced into stocks. But if a model using only public data can get even a small predictive edge, well, what does that really say about how efficient the market truly is? It suggests there are still clues out there if you just know where to look.